Welcome back to day 5 of our investment strategy series. Today, we're diving headfirst into the turbulent waters of tariff uncertainties. Listen up, people, because these tariffs are like rogue waves in the market, and they can really rock your portfolio if you're not careful. We're talking about the kind of economic headwinds that can make or break your returns. But don't you worry, because today, we're going to equip you with the knowledge and strategies you need to not just survive, but thrive in this volatile environment. We're talking about understanding the impact of tariffs on different asset classes, from stocks to bonds to commodities. We're talking about diversification strategies that can help you weather any storm. And we're talking about hedging techniques that can protect your hard-earned money. So buckle up, because we're about to navigate these choppy waters together. Alright folks, let's break down how these tariffs can impact your investments. First up, we've got stocks. Tariffs can create winners and losers in the stock market. Think about it. Companies that rely heavily on imported goods, they're going to feel the pinch of those tariffs, and their stock prices might take a hit. On the flip side, domestic companies that compete with those importers, they might actually benefit. But remember, it's not always that simple. Tariffs can disrupt supply chains, increase costs for businesses, and ultimately hurt consumer spending. That means even companies that seem like winners at first could face headwinds down the road. Next up, commodities. Tariffs can send shockwaves through the commodities markets. Think about agricultural products, industrial metals, energy. All of these can be impacted by tariffs. Higher prices for imported materials can eat into corporate profits, and that can translate into stock market volatility. And don't forget about currencies. Tariffs can influence exchange rates, which can impact your international investments. It's a complex web, but understanding these interconnected relationships is crucial for making smart investment decisions in a tariff-heavy environment. Listen, when it comes to tariffs, diversification is not just a buzzword, it's your lifeline. You can't just bet on one sector or one country and expect to come out on top. You need to spread your risk, folks, and that means diversifying your portfolio across different asset classes, sectors, and geographic regions. Think about it. If you're only invested in companies that are heavily exposed to tariffs, your portfolio is going to take a direct hit. But if you've got a mix of domestic and international stocks, bonds, real estate, and maybe even some alternative investments, you're creating a buffer. That doesn't mean you won't feel any bumps in the road, but it does mean you'll be better positioned to weather the storm. Remember, diversification is all about not having all your eggs in one basket, and in a world of tariff uncertainty, that's more important than ever. Okay, so you've got your diversified portfolio, but you want to take things a step further, right? You want to play some defense against these tariff headwinds. That's where hedging comes in. Now, hedging might sound complicated, but it's really just about using financial instruments to protect your portfolio from potential losses. One way to hedge against tariff risks is through options. Options give you the right, but not the obligation, to buy or sell an asset at a specific price. So if you're worried about a tariff-induced decline in a particular stock, you could buy put options, which would give you the right to sell that stock at a predetermined price, limiting your potential losses. Another hedging tool is futures contracts. Futures are agreements to buy or sell an asset at a specific price on a future date. You can use futures to hedge against potential price increases in commodities that might be affected by tariffs. And then there are safe haven assets like gold and bonds. These assets tend to hold their value or even increase in price during times of economic uncertainty. Adding some gold or bonds to your portfolio can provide a cushion against tariff-related market volatility. Now here's a crucial question. When it comes to tariffs, are you in it for the long haul, or are you looking to make some quick moves? Your investment horizon matters, folks. If you're a long-term investor, you don't want to panic and sell everything at the first sign of tariff trouble. Remember, markets go up and down, and tariffs are just one factor to consider. If you believe in the companies you've invested in and their long-term prospects, riding out the storm might be the best strategy. However, if you're more of a short-term trader, you might be looking for opportunities to capitalize on tariff-related volatility. This could involve buying stocks that you believe are oversold due to tariff fears, or using options to profit from short-term price swings. But remember, short-term trading is risky, and it's not for everyone. Before you make any moves, make sure you understand the risks involved. Listen, in the world of investing, knowledge is power. And when it comes to navigating tariff uncertainties, staying informed is absolutely critical. You need to be on top of the latest trade policies, economic indicators, and central bank decisions. Keep a close eye on trade negotiations and any announcements about new tariffs or changes to existing ones. These developments can have a significant impact on the market, so you need to be in the know. Pay attention to inflation rates. Tariffs can contribute to inflation, which can erode the value of your investments. Central banks often respond to inflation by raising interest rates, which can also impact the market. And finally, don't underestimate the power of research. Read industry reports, follow market analysts, and stay up to date on the latest economic data. The more informed you are, the better equipped you'll be to make smart investment decisions in the face of tariff uncertainty. Remember, knowledge is your best defense against market volatility. So, there you have it, folks. We've covered a lot of ground today, from understanding the impact of tariffs to diversification strategies, hedging techniques, and the importance of staying informed. Remember, tariffs don't have to be a portfolio killer. By staying informed, diversifying your investments, and using hedging strategies when appropriate, you can navigate these choppy waters and come out ahead. Don't let tariff uncertainty derail your financial goals. Take control, stay informed, and keep investing wisely. Thanks for watching. Make sure to subscribe and hit the bell icon for more insights on navigating market uncertainties. See you tomorrow for day 6.